Good morning, sir. We are Group 1, and today we are going to present the financial statements analysis. And I'm Sammy, and my members include Oliver, Angeline, and Josephine. And here is the outlines. First of all, I will talk about the vertical analysis of the income statements and the balance sheets. And afterwards, Oliver will talk about the financial ratios analysis. Next, Josephine will talk about the financial health evaluation. Last but not least, Angeline will talk about the plans and recommendations. So let me begin from the vertical analysis of the income statements. Here is the data of the Alpha company. The sales of the company is 770,000, and the cost of goods sold occupy about 70%, which means the gross profit is nearly 30%. For the expenses, the operating expenses is nearly 6%, while the interest expenses is nearly 1%. The net profit before tax is 23% of sales, and the income tax expenses is nearly 1.9% of the sales. And last but not least, the net profit after tax is about 21.1% of the sales. And here is the data of the Beta company. The sales of the Beta company is 880,200. The cost of goods sold is 67%, which means the gross profit is about 33%. The operating expenses is nearly 4.9%, and the interest expenses is about 1.5%. And the net profit before tax is about 26.7%, while the income tax expenses is nearly 2.8%. And lastly, we can see that the net profit after tax is about 23.9%. So we can have some observations. The Beta company has a higher gross margin and a higher overall net profit margin with a lower operating expenses ratio. This means Beta company is more profitable. Beta company spends less on operating expenses relative to sales, which means having a better cost control. Beta company has a higher interest expense as a percentage of sales, which means having a great use of debt financing. So let's talk about the vertical analysis of the balance sheet. Here's the data of the other company. The total assets of other company is 444,400, and the cash is occupied about 4.4%. For the accounts receivable is nearly 10.4%, and the merchandise inventory is about 18.9%, and the prepaid expenses is 1.1%, and the property, plant, and equipment occupy about 65.1%. For the liabilities and equity, the current liabilities occupies 30.8%, and the notes payable occupies about 18.1%, and the share capital is nearly 40.4%, while the retained capital is about 27.7%. And this is the data of the Beta company. The total assets of Beta company is 542,450. For cash, it occupies about 6.3%, and the accounts receivable is nearly 11.9%. The merchandise inventory is 24.4%, while the prepaid expenses is 1.3%. And the property, plant, and equipment occupy 56.1%. For the liabilities and equity, the current liabilities occupy about 70.2%, while the notes payable is 80.6%. The share capital is 38%, while the retained earnings is about 26.2%. So here is the key observation. Beta company holds proportionally more cash and inventory, but less property, plant, and equipment than Alpha company. Alpha company has a higher equity ratio, which means having a strong reliance on owner funding. So Beta company is slightly more leveraged in current liabilities. And here is come to the end of my part, and I will pass to Oliver to talk about the financial ratio analysis. Thank you.
Thanks, Sammy. Now I will compare alpha and beta using their key financial ratio and highlight what this number mean for performance, risk, and investment choices. The first part is liquidity and efficiency. Alpha's working capital is lower than beta, but it manage is cash circle better. We can probably see here, account receivable turnover is 20 times, with just 22 days outstanding compared to Beta's 27 days. Inventory turnover is also faster, 57 days for Alpha versus 82 days for Beta. This means Alpha converts sales into cash more quickly. However, if its inventory become harder to sell, short-term liquidity could still face pressure. Beta appears more liquidity on paper, but a large amount, like 132 million inventory weighs on its quick ratio and pose risk of stock building up. The second part, profitability and financial risk. On profitability, Beta is a clear leader. Gross margin is 33 percentage versus Alpha 30 percentage. Net margin is 24 percentage compared to 21. Return on equity is nearly 65%. Well, about Alpha's 56%, but as a part of the age comes from higher leverage. We can see Beta's debit to equity is 0.56, while Alpha is only 0.47. When we look the interest converge, Alpha is stronger at 23 times compared to Beta, 19 times. This means Alpha can absorb earning volatility more comfortability, while Beta face higher sensitive to downturn. The third part is about market view and strategy from market perspective. Beta trade at lower PT ratio of 13.7 versus Alpha 16.6. This discount reflects investor caution about Beta's leverage and inventory risk. Both firms pay the same dividend yield of 5.07%. So the key difference lies in their ability to sustain payout through the reinvestment and cash generation. Structurally, Alpha sounds focus more about inventory further to release cash for growth. Beta, on the other hand, must improve working capital efficiency and gradually reduce leverage to balance risk and return. For investor, Alpha offers a cleaner balance sheet, stronger interest cover, and a fast cash circle. Is more suitable for conservative and dividend-oriented investor. However, Beta provides a higher margin and stronger return, but with greater execution risk. It may attract some like return-seeking investor through successful depends on the working capital control and better leverage discipline. Therefore, Alpha is more safer. Steady performance, while Beta with higher risk. The choice will depend on the investor prefer suitability or a higher return. Now I will pass to Josephine for next part. Thank you.
Thanks, Oliver. Now I will be presenting on evaluation of the financial health of the companies, which is referred as alpha and beta. This analysis is based on 5 key areas: liquidity, solvency, efficiency, profitability, and market perspective. By comparing these, we can see which company is financially stronger and what that means for investor. Let's start with liquidity, which looks at how well a company can pay its short-term obligations. Alpha has a current ratio of 2.53 and a quick ratio of 108, both healthy numbers above 1. Its receivable turnover shows it collects payment in about 22 days, and its inventory cycle is 57 days, both considered efficient. On the other hand, beta's ratio are similar, but its inventory is held longer at 82 days, and its receivable period is 27 days. This slows down its cash flow. So, in terms of liquidity, alpha is more efficient and stronger than beta. Solvency is next, which measures long-term financial stability. Alpha has a debt ratio of 31.9% and a debt to equity of 0.47, meaning it relies more on equity than debt. Its interest coverage ratio of 23.4 shows it can comfortably pay its interest expenses. Beta, however, carries more debt, with a debt ratio of 35.8% and a debt to equity of 0.56. Its interest coverage is lower at 19. While still manageable, beta faces higher financial risks. So overall, alpha is financially safer in the long run. Efficiency tells us how well the company used their assets. Alpha is stronger in receivable and inventory turnover, showing good control of cash flow and stock. Beta, however, slightly outperforms in total asset turnover, meaning it generates more sales from its overall assets. In summary, alpha is better at day-to-day efficiency, while beta is slightly stronger in assets utilizations for revenue. Now, profitability. Alpha shows strong margins and returns, but beta outperforms in every measure: gross margin, net margin, return on assets, and return to on equity. Beta clearly generates higher profits, though this comes with higher risks. Finally, from the market perspective, alpha has a higher price to earnings ratio, about 16.6, compared to beta 13.7. This suggests investors value alpha stability and lower risk, even though beta earns more. Both companies offer the same dividend yield, about 5%, but alpha is seen as the more sustainable option. In conclusion, alpha is safer, more stable investment with strong liquidity, lower debt, and steady cash flow. Beta, meanwhile, is the more profitable company but carries high risk due to its debt and slower cash cycle. So, alpha is ideal for investors who prefer stability, while beta suits for investors who are willing to take on higher risks for potential high returns. Thank you, and now I will pass to Angeline to talk about the recommendation from our team.
Hi everyone. Thank you, Josephine, for the outline that you gave in our companies that we were looking at, the beta and the alpha companies. So I'm now going to look at the recommendations on the investment. Okay. So if you look at the first slide for alpha, for the liquidity ratio, so the alpha company shows that it's got more than it's greater than 1, the liquidity ratio. So it means that for any company which has any ratio which is greater than 1 is doing well. So both companies, alpha and beta, have this. But now what makes me say I have to invest in Alpha company is the rate at which they collect the receivables. So Alpha takes 22 days, while Beta takes 27 days to collect receivables. So it means that Alpha can generate cash quicker, and it is a very good advantage for this company because it will be able to pay for any purchases in any time and less costly than Beta, which will end up having borrowings. Okay, so when going to the next slide, we're looking at the solvency advantage. So if we look at the solvency advantage, it shows that Alpha has got less debt. Actually, it shows that it doesn't rely much on the borrowings, and Beta company shows that it relies more on the borrowings. So this is shown by the ratio of 31.91% to 23.41, not percent, to, so I didn't put the other percentage for the other company, but when you look at the interest incurred on the borrowings, it shows there it's like 23.41 times versus 19.05 times. So it is a very wise decision to consider that when investing. So investing in Alpha is a good thing because Alpha stands in a better position, so not many restrictions will be imposed by banks on the borrowings. And then Beta has a higher debt ratio, so that's a very unfavorable when it comes to investing. When you go to the efficiency on the next slide, Alpha still proves to be in control in handling receivables turnovers with a ratio of 21.85 times of the inventory turnover, but then Beta has only 7.7, which shows that it is less efficient, or it's just too slow in selling their stocks or in selling their products. So Alpha has a very strong cash flow from high grade customers that will reduce the need for borrowings, and it will reduce credit interest. Beta is not favorable when it comes to investing because it is also already at the risk of liquidation because it's got high borrowings. So investors wouldn't favor any company which is going to be liquidated because they already know that their shares will be affected, their dividends or the money that they get as shareholders, whether they are preferred shareholders or common shareholders. So Beta is still my negative one when it comes to investing. And when we go to Alpha, when we go to the market perspective on the next slide, it shows that Alpha, even though it's on my favorite list, it shows on my favorite list of investments, it shows that it's got a slightly low gross margin and also net margins, but Beta shows that it has higher gross margins. But still, I wouldn't put it Beta for recommendations for investment because it still look at the other market perception, which is like if you look, some companies have dividend yields of 5%, and but Alpha will still have higher investor confidence because it has less risk and also of liquidation, which stands on the ratio. When we're looking at the ratio stands on 16.63. So there is less risk for Alpha to be liquidated because it's got enough cash flow to do anything that they want, and it's got stable returns, whether they're not, even if they're not higher, it's Beta. And it shows that, for my analysis from the top there, it shows that it's got smooth day-to-day operations, like having good customers, and they know how to manage the inventory and also have low debt. So Alpha is still favorable. And thank you so much for your time. Thank you.